Hey everyone, welcome back to Corporate Decoder. Today we're diving into something that might sound dry at first, but trust me, there are a lot of interesting things and maybe a couple of nasty surprises hidden in this iShares Trust annual report. Ready for the truth? This report reveals which dividend ETFs are thriving and which might be struggling to keep up. Before we start, if you enjoyed taking a peek behind the curtain of corporate finance, make sure you're subscribed. We also have a Discord community linked in the description below. Let's get started. We are cracking open iShares' annual shareholder report. iShares is a big name in the ETF exchange traded fund world, and this report gives us a peek under the hood of some of their popular dividend focused funds. We'll break down what they invested in, how well they performed against the market, and flag any risks lurking in the fine print. It's like a treasure map, but instead of gold, we're looking for financial insights. First up is the iShares Core US REIT ETF, or USRT for short. This fund focuses on real estate investment trusts, or REITs. Think of REITs as companies that own and often operate income-producing real estate. What we want to know is, how did your REIT investments actually do this year? Let's talk costs first. For every $10,000 invested in the iShares Core US REIT ETF, it cost you about $9. That's a tiny otherboard 0% cheap. These small expenses can really add up and eat into your return, so this fund doesn't seem to have that. Now, how exactly did this ETF perform during the reporting period that ended in April? Well, the fund returned 15.03%. That's pretty solid, especially with recent broader market conditions. It's right about on par to the Nareit REITs index return of 15.07%. Looks like the USRT did its job pretty well. Where did this REIT return actually come from? Well, the report says a lot of it came from data centers and self-storage REITs. The fund also reported that hotel and resort REITs actually hurt performance. It's a mix of different real estate types really impacting the performance. Looking at the fund's key stats, we see net assets totaling at about 2.8 billion, 2,857,294,569 to be exact in USD. So this is a big and popular fund. The report also mentions a portfolio turnover rate of 7%. This means that approximately 7% of the fund's holdings were replaced within the year. It's relatively low and could suggest little to no changes in the underlying strategy of the investments or index. Important to all this report is that the fund's underlying index has been updated under a new underlying, the Fixed Nareit Equity REITs 40 Act Capped Index. Make sure to check and understand how this new index could affect your investments, as diversification rules might change. Next is the iShares Core Dividend ETF, symbol DIB. This fund focuses on dividend paying stocks. Now, like before, what really matters is how it actually performed. First off, its costs are even lower than before with a tiny expense of just 5 per 10,000 or 0.05. DIVB here performed slightly better and gave investors a return around 12.25%. It's good solid performance, but investors always have to consider past success is not an indicator of future potential. Just because it did well now doesn't exactly mean it will do well later. This ETF's major success was linked to the rocketing information technology sector. Software and hardware, they all benefited, but energy stocks didn't do nearly as well. Interesting to note that some sectors, even if they are broad, do much more than others. Its total net assets are 736 million, which is lower than our previous fund and a turnover rate of teddy within this one than within the US REIT ETF. This ETF reports its largest holding is Cisco Systems at 4.8%. Followed by International Business Machines Corp at 3.4%. Moving on, now we need to decode iShares Core Dividend Growth ETF. Does it just look at dividends? It specifically goes for companies expected to increase their dividends over time. Like the previous reports, the fees are pretty low, where the cost of a 10,000 investment is just 8 ACA 8 Bexalma rate, 8 0 hours. For the period, this one returned back to earth at roughly 10%. Information technology were profitable, while energy dragged down performance quite a bit. Can't S with the previous report. And this one, energy really seems to be a drag on dividend ETFs, despite being an important sector. So the dividend numbers are down a little bit overall. Looking at the stats, it's a really big fund to the tune of 30 billion and its portfolio turnover rate is at 25%, making it a very hands-off, relatively large fund. Compared it with the 36% of the DIB ETF, so nothing too crazy. Its biggest holding is at about 3%, composed by Microsoft and JP Morgan Chase & Co. with equal parts. Now, what about the iShares Core High Dividend ETF, or HDV? In this one, the main focus is maximizing the current dividend yield, even if it means sacrificing dividend growth. This strategy can lead to high income now, but may not keep pace long term. Like the previous reports, not to repeat myself, but we like seeing a low cost for these kinds of funds. This fund is at 8 TOC and has an expense ratio of 0.8%, making it one of the cheaper players. As for HDV's performance, the fund returned 10.69% due to good performance on its consumer staples like tobacco and utilities. The return was hurt, however, by holdings from energy. As you would assume from its strategy, its key fund statistics is where performance and fees aren't the only thing we want to look at. Total net assets are 11 billion with a small amount of holdings only at 79. This is because it's focused on specific investments that are performing but maybe not the best choice. The turnover rate is crazy high at 82%. This one has ExxonMobil as its highest holding at 7.8%. So its performance and that of its sector will heavily impact this one. Finally, the iShares Select Dividend ETF, trading with the symbol DBY, is the grand finale. This fund focuses on high dividend yields, but also factors in the dividend payment history of the companies it invests in, looking for some level of reliability. The final one, it's a little more expensive than the others, with a 40 investment per 10,000, with a ratio of 0.38%, but nothing outrageous to be honest. Devi performed at about 11%, pretty standard around the other numbers reported this year so far. Utilities and financials kept performance high as they were offset by chemicals. Keep an eye to check sector allocation numbers. Total assets of about 19 billion over 104 holdings with low rate turnover. As you can see, some themes are apparent. The highest holdings appear to be Aria, Gropup and Verizon. It seems that more emphasis relies upon defensive ETFs, those focused on lower risk high yields with solid and consistent financial backing. Take in mind the investment management agreement was amended in December to disclose the breakpoint fees to the 6th decimal place at TD overall view. That was all the ETF fillings. Some sectors did well and some sectors did not. And these had impact in some of the ETFs that were more focused than others. For example, energy almost always underperformed compared to the rest. Alright, that's our breakdown of iShares' latest dividend ETF filings. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.